We're taking a look at the gold market here, trading last at 1551.70, down about 240. The numbers on the left of the chart are the daily algorithms for today that identifies for us the average price at 1553. The extreme level above that average price is 1560, sell one level. The sell to level is 1565. The extreme level below the mean is 1547, which is the buy one level, and the buy two level is 1541. What you're looking at is the Fibonacci structure that we use to trade the reversion to the mean principle, in that the VC PMI algorithm identifies for us 5 levels, 5 pivot levels to use. Transforming those pivot levels into identifying the extreme of the supply and demand for the day, for day traders, as you can see here, and the color identifying basically the extreme levels of the supply and the demand. If you're looking at the chart, the red color from cell 1 to cell 2 represents an area of the what we call distribution of supply, which means that when the algorithm runs up into this area, the artificial intelligence identifies for us that it's a very high probability that once the price confirms by activating a short trigger using specific criteria on a close below the sell one level, it activates a bearish trigger. And as you can see here, on the 8th, the market got up to this level of 1560, and it pretty much came down. It met the target of the mean, which is the next level below, and it went to the extreme level below the mean of buy one and buy two. The mathematical probabilities identifies the average price at a 50-50 standard deviation. And what I do as a self-directed trader, what I suggest my traders, my subscribers, is basically to choose to trade the highest probabilities when you're trading the markets. And that is essentially when the price either reaches the extreme level above the mean of 1560, which has a 90% probability, or it comes down to trade below the mean into the buy one, buy two level, which is identified in blue as the area where you potentially are going to find buyers, and that's what the algorithm tells you. The area in blue is where potentially you're going to find buyers. Buy one is 90% probability of a reversion occurring. Buy two is 95% probability occurring. And as you can see here, the market came right down into buy one. It did not activate a buy signal. It came down to buy two, and then activated a buy signal from buy two at 41, 47. It met the target, and then it pretty much triggered the buy signal from the buy one level, meeting the target or the mean of 1553 by the 9th of January at 4:45 a.m. So the signal literally took overnight to complete the target. Now, when the price reaches and meets your goal on the average price, you go neutral. And I suggest, again, do not trade the average price. Wait for the price to either go above the mean or below the mean. Standard deviation is only 50-50 standard deviation. I'm looking for 50-90 standard deviation. And that is when the price comes down again to the buy one level like it did here on the 9th at 7:45 a.m. and it activated a buy signal by closing above it at 15:48.80 and meeting the target again of 15:53. So that's another approximately $500, $4 or $5 profit the same day. So now you see two trades that we've been that has been activated from the buy one level. You liquidated your profits here. You do nothing. You wait. You go neutral. You wait. Let the market trade standard deviation. You wait. You wait. You wait. It comes down again on the 9th at 8:30 p.m. Activates the 1547. Activates a buy trigger. Your stop automatically when it is activated is the level below or the level above. In this case, the buy signal from 1547.80 had a stop at 1547. The target again was 53. As you can see here, this is another signal that was completed since the 8th. So what you see here is the incredible synergy of the price or the market trading within this Fibonacci, perfect Fibonacci structure. And you see the probability factors here unfolding, realizing once the signal is activated, the market resolves itself and meets the target. Now, we did not quite come down to the buy one level here at 1547. Obviously, the market tried 3 times to break that and it couldn't. And you can see here that the buyers realized that and they decided to buy the market before it meets that target again, penetrating it right through that average price of 1553. And a lot of trading occurred in that area at 5:30 a.m. on the 10th of January until the market gravitated above the average price of 1553 and closing above it activated the target above, which is the 1560 target that was completed on the 10th at 7:45 a.m. Now, this is a high probability area for a trade if the signal is activated. And here it was activated at 59.70. Automatically your stop is a close above, which was 1560.70. So it was like a few change, a small loss from 59.70. That's a 70-cent loss. Okay, you wait. You go short again at 59.70, and the market gives you a little bit of profit. Automatically, you put your stop above it so that here it stops you out again. If you did not trail your stop, protecting whatever you had, the minute the market goes your way and the momentum unfolds, trail your stop to break even. At worst case scenario, if it stops you out like here, you break even. Then you wait. You do not buy between sell 1 and sell 2. Why? Because selling up here at sell 1 is a 90% probability. Buying, you only have a 10% probability. Even though the market may run up, the probabilities increase that as the market runs up into this area of distribution, you're going to find sellers, as it did here. When the price confirmed a short trigger, a lot of trading took place. It stopped you out again. Very small losses. And finally, you kicked in a short trigger once again. And the momentum unfolded in this bar here, coming down to a low of 1555. From 59.30, that gave you enough room for you to lock in a profit if you traded with a stop as the market comes down, and eventually comes down and it meets the target of 53 again. You go back to neutral. So now that's a trade from 60 to 53. That's another approximately $7 profit that it took. You go neutral again. The market activates another short here. But when the signal is triggered from the mean, it identifies the price momentum. You do not trade, but you watch the price momentum where it wants to go. And here it came down right into that B1 again, with 90% probability that the market is going to revert. Sure enough, the close of the next 15-minute bar activated a buy once again at 48.90. The target once again was 53. It was completed. It ran up above the average price. Do nothing. Boom. Comes down, activates another short trigger. Comes down a few dollars here. You have a choice to trade it with a stop or use the close above it. It goes neutral again on this bar at 7:30 a.m. on the 13th. At 7:45, it activates another short trigger at 52.30. And the target automatically is the 47. And bingo. Completed. But once again, when the trigger points give you a signal now between buy 1 and buy 2, you do not buy or sell unless the confirmation, you buy with the confirmation above the pivot, either at buy 1 or buy 2, but you do not sell into this area, even if the market comes down, so that the market can resolve the probability factor. And as you can see here, it dropped below the B2 level, which is extremely oversold, and it gravitated once again from making a low of 1536.40, which puts us almost into that weekly number. The market rallied again, activating another buy signal on the 13th at 11:30 p.m. from 1542, run up against the target above of 1547. You can go neutral, take your profits, wait. Comes down again to the buy 2 level, activates another buy signal. As it comes down to the level above, depending on the multiples, you can use these levels to sell part of your position. But I'm just showing you here the logic of how accurate this incredible tool is. And you can use it as a GPS for your trading once you understand the methodology and the artificial intelligence behind. Right now, it activated another buy signal here on the 14th, 7:30 a.m. It ran up right into that target above of 47. That's another $6 profit. I've lost track of how much profits this system is making. You can calculate it yourself, and you can confirm it yourself right here. The market traded around the buy 1 level until once again the 14th at 3:30 p.m. It activated a buy signal from 1547.30. Your stop is 47, and they got up to already 48.80. I'm sorry, 15.50, 60. So it gave you enough room again to lock in your profit with a trailing stop. Market came down. It did not stop you out. Activated another buy signal. Boom, it rallied right into the target of 53. Do nothing. Wait till the market reaches the extreme. It gave you a bearish price momentum here. Boom, it came down again to that buy one level, activating a buy signal. The target was completed again. This is amazing as I'm doing this analysis into the code and the price relationship, how accurate it is. Finally here, the market ran up above the average price. You did nothing. You watch. Back down again in below the mean, and that's why I say don't trade the average price. You're going to get chopped up. Just wait for the highest probability trades. And that is where we are right now, waiting for the highest probability trade. And that is either for the market to come down once again and activate a buy signal at 1547 by touching the price and closing above it on the second 15-minute bar. It would be a buy trigger. If not, it would come down to that buy two level of 1541, and using the same artificial intelligence, now you know where to execute the highest probability trades for today. If the market runs up above 53 and closes above it, then automatically it activates the targets above of 1560 to 1565. It has been a tremendous week and month for us in using this algorithm here, particularly as we trade some of the derivatives that are related into the gold market. For now, I hope that you can digest the intelligence that I'm sharing with you here and continue to watch the daily VC PMI early bird update that will be giving you the most advanced trading intelligence that you can find on the internet, live streaming here in Tocker. This is Patrick MontesDeOca. It's my pleasure to share this with you here. We'll be updating live streaming here throughout the day. Have a great trading day. We'll talk to you soon.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VC PMI, is an automated AI trading system developed and tested over a decade. The VC PMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VC PMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VC PMI algorithm. The VC PMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VC PMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VC PMI? The VC PMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VC PMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VC PMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.